Do you consider this morning's number sort of a push or some marginal improvement in the inflation picture?
Well, it's certainly more of a push and certainly more of a tie between the dovish and the hawkish, views in the market today. Like you can basically take any side and look at this report to confirm your views one way or another. On the one hand, the report suggests that inflation still high, and therefore that gives the Fed and all Fed officials, more ammunition to continue its hiking, path. On the other hand, you will basically say that the long-term trend on inflation is coming down, and therefore, the possibility that the economy will stay in a soft landing will probably be the best case scenario. So you can actually basically play both sides.
Are you a proponent or a follower of this view that getting to 4, let's say, can be done, but getting to 2 will be multiple in terms of difficulty? And if so, does the market have a moment of clarity when they come to the realization that that may be the case?
Well, we have several forces on this, Carl. On one hand, we have the market dynamics that basically tells us on the equity market, they basically giving us one particular view of what this might look. And what that basically tells us is that it probably thinks that the rate we're going to get to that 2% is going to be faster. And certainly the equity market seemed to be fairly optimistic, at least up to yesterday, to basically think that, yes, we're going to be in the soft landing or no landing scenario. On the other hand, you have the bond market, and the bond market is giving us a very different picture, very, very much in the camp of an inverted yield curve that is really, really, historically, high, and that widen between the 2s and the 10s, that basically suggests that there will be a recession, and therefore the Fed will probably need to just stay a little bit aware of the financial conditions. And then the last thing you have is the economic data, and as we said, look at this morning data, that would suggest that the pace for getting to that 2% is going to take longer. So our point of view is that because we have these rolling, pieces of the economy moving, that this is going to probably take some time before we can get down to 2%. Maybe just to get to 3 to 4%, at some point during this year, but it's going to take much longer to get to that 2%.
Omar, where does that leave you, though, in terms of trying to assess the risk-reward when it comes to things like equities? If you feel as if that they've priced in a pretty friendly scenario by now and you think the bond market is taking issue with that?
Well, certainly, the equity market, has these particular characteristics of look through and trying to extrapolate the future, probably down the road, regardless of how long the economy and the economic data actually takes to look. So it's usually ahead of the curve. Now, the challenge with that is that, in order for the equity market to be a little more clear on where that is going to go, we need a little bit of a stability. And I think from our point of view, the stability of yields in the bond market is exactly what will probably determine that inflection point. Because if you look at just the 10-year yield and the volatility of that 10-year yield just in the last couple of weeks, it's just been, incredible to actually just see how much and how fast that moves. And it's not until we get a little more stability of those yields and therefore prices to actually on inflation that we'll actually gonna get a better sense of what the market. So we expect more volatility in equities until we'll get more stability on bond yields and a little more clarity on this rate of inflation decay.
So does that mean that at this point that you are not warming up to increasing your weight, let's say, in equities? Are these, we mentioned some of these 6-month T-bills, does that remain a nice place to park?
I think the ability for us to actually just open the possibilities, if, we have been discussing these, even from the last quarter, in the fourth quarter, we say like TINA is pretty much dead. And now, it's open up to a lot of really good possibilities. The yields that you get on the short part of the curve in fixed income is something that, it's very open now that we didn't have before. And if you actually wait probably for, 12 months to 18 months, you're probably not going to get as much as you can actually get today. So in many cases, opening up to different diversification options, including bonds, it's probably more open than not.
Right. I always think back to the time where there was no alternative. Certainly not the case, arguably, today, Omar. Thanks so much. Good to see you.